Hi everyone, my name is Mark Quinn. I'm a tax advisor and chartered financial planner based in Portugal with the Specialise FA group. And in this video I'm going to look at 20 common questions we're asked by new residents to Portugal. So the first question is the most obvious, and it's how do we actually establish residency in Portugal? Well, if you're a citizen of an EU EEA state or Swiss, then you have an automatic right to reside here. It's simply a matter of going to your local town hall and getting a residency certificate, which will cost you €15, and you're effectively in, you've got legal residency. For non-EU nationals, which now obviously includes British people, you now have to go through some sort of visa process. And the most common one at the moment I'm seeing is a D7 visa. So what that is it's also called a passive income visa. It's just a visa whereby you have to show that you're in receipt of a minimum level of income, equivalent to the Portuguese minimum wage, which is about €750 a month. And that can come in the form of dividends, interest, rent and pension. So anything passive in nature that you're in receipt of, as opposed to earned income, which is active income. Historically, some people use the golden visa process. That was a visa whereby you just had to inject some capital into Portugal, depending on what type of investment you were dealing with, the amounts changed, but most commonly people were buying property here for at least 500,000. However, last week, in fact, the Portuguese government said that they were scrapping this form of visa, so that's no longer going to be available going forward. So the next question is, when do we become tax residents in Portugal? Now, Portugal has two definitions of tax residency. One is that you've exceeded 183 days in the previous 12-month period. So it's not a calendar year, it's a rolling 12-month period. The other one is if you switch your habitual residence to Portugal. So that means that you don't necessarily have to be here 183 days or more to be a tax resident. You can be a tax resident with much less time here. In fact, from day one, assuming Portugal is now your main home. Also to note on that point is that Portugal by default offers a split year treatment. So that means that you can come here and it doesn't matter what point in the year you arrive, you can be tax resident from that point onwards. The next logical point after that is, if you've become Portuguese tax resident, how do you know when you've left your current tax net? So if you're a UK tax resident at the moment, for example, how do you know when you've ceased tax residency over there? Now the rules around this are quite complicated, but the default position from a UK standpoint is that you're either tax resident for the whole year or not at all. Now don't forget there's a staggered tax year situation because Portugal has a calendar tax year basis and Portugal runs from April to April. But as I say, the UK tax system is binary. You're either tax resident for the whole year or not at all. So let's take an example. Say if you left the UK in, say, November or December, because you spent so much time in the UK during that fiscal year, you're likely to be considered tax resident up until the following 5th of April, even though you're no longer in the country. Now, there is exceptions to this. There's 3 exceptions. They're called split year treatment from a UK context, and there's 3 cases that you can fall under. And that means that you can actually leave the UK tax system behind at that point. So you arrive here in November or December, you can actually cease UK tax residency at that point. However, the rules around that are quite complicated, so do get in touch if this is going to be relevant for you. On that note, I wanted to cover a very specific question which is applicable for people that are going through the visa process now, and they're at stage 2, so they're over here in Portugal waiting for their stage 2 or final residency permit to be granted. And the question they're asking me a lot is, when do I actually have to become a tax resident here? Because in that situation, what's happened is they've left the UK, possibly many months ago. So they've left the UK tax system. And in many cases, they've also been here more than 6 months. So they're clearly a tax resident here. But in practice, because of the way the Portuguese tax system works, they can't actually be a tax resident here yet until they've got their official residency permit. So it's a bit of a chicken and egg situation, and what they're finding is they're effectively in no man's land. They're not tax residents in the UK, but nor are they tax residents in Portugal yet. So if this is the situation that you find yourself in, please contact us and we can explain the situation and maybe put a roadmap together for you. So the next series of questions around how is income and gains treated in Portugal. So we'll first consider the position as a standard Portuguese taxpayer. So people that aren't members of the Non Habitual Residence scheme, which we'll cover later. Now, Portugal, like many other countries, operates on a worldwide income and gain basis. So once you're a Portuguese tax resident, you have to declare your worldwide income and gains to the Portuguese tax authorities. And how will they be taxed? Well, it depends on where you're receiving income from. So if you're receiving income from dividends or interest, both of those are going to be taxed at a flat rate of 28%. The exception is if they're deriving from a blacklisted jurisdiction. So blacklisted jurisdiction examples are the Channel Islands or Isle of Man. If you're getting income and dividends from those countries, it's going to be 35% instead of 28%. How is rental income taxed? Well, rental income again is 28%. However, you do have the ability to aggregate your rental income with your other income sources. And if that results in a lower tax rate through the standard progressive bands, which we'll cover shortly, you can elect to use that lower tax rate rather than the flat 28% tax. And the final question is, how are capital gains taxed in Portugal? And again, it's a flat rate of 28%. Just one point on that is that there still is indexation relief that applies to directly held shares and securities. We did have that form of relief in the UK many years ago, but it was abolished. What is indexation relief? Well, it's simply a mechanism to allow for inflation over time. So imagine you bought a share for £100 10 years ago, and inflation over that period between the time you bought the share and the time you sold it is, say, 20%. The Portuguese government will allow you to uplift your base cost by 20%. So your effective cost is now £120 instead of £100. So that reduces the taxable gain. So what are the standard tax rates that you'd pay here as a Portuguese tax resident? Well, I've covered that in the description below. There's a banding system as we have in the UK. So if you earn between a certain amount, it's say 20%. The next band is 40%. And above that 45%, etc. There are more bands in the Portuguese tax system, and again I've put those in the description below, but they start at 14.5% and go as high as 48%. Does Portugal have inheritance tax? Well, no, it was actually abolished in 2003. There is a form of succession tax known as stamp duty that can apply. However, it's so limited in its application that I've never seen it apply in practice. And the reason is because it doesn't apply if you're leaving assets to your direct line descendants or ascendants, and it doesn't apply if you're leaving assets to your spouse. Also, even if it did apply, it doesn't apply to non-Portuguese assets, so it only applies to assets based in Portugal. So as I say, it's very limited in its application. On that point, in relation to succession, just be aware that Portugal does have forced heirship rules. So unlike the UK, where we have free disposition over our estate, we can leave it to anybody or any institution we wish, like charities, the Portuguese state will actually dictate how your estate should be distributed and in what proportion. Now, just be aware that you have the option under an EU directive called Brussels 4, Brussels 1V directive, and that actually allows you to use the law of your nationality rather than the law of Portugal in the reading of your will. So you can have a Portuguese will, but based on UK succession principles to bypass the forced heirship rules. Next question, does Portugal have a wealth tax? Very quick and easy answer, no it doesn't, unlike, for example, our colleagues in Spain who have to deal with a wealth tax there. What's the Non Habitual Residence scheme? Well, NHR is a 10-year tax scheme that's available to new residents of the country. So there's one main qualifying condition, and that's you haven't been a tax resident here in the last 5 years. Assuming you haven't been tax resident here in the last 5 years, you'll qualify for NHR. It's very simple. How you'll be taxed as a non-habitual resident will depend on what planning you put in place before you move to Portugal and how your assets are structured. So ideally speak to us before you move here and we can advise you as to how to best plan for NHR status. The tax that you pay under NHR depends on the different sources of income and how your assets are structured. So we'll just look at the main ones now. The first one is employment and self-employment income. So how will I be taxed on my earnings? Now, as a standard position, you're taxed here if you perform the work here. So irrespective of whether you're NHR or not, if you're performing the work from inside of Portugal, even if it's for a UK employer, getting paid in sterling to a UK bank account, you'll still pay tax here, and you'll pay tax at the standard rates we spoke about earlier and go through the bandings. Now, there is an exception to that, and that's for what's called high valued activity. So if you fall under a high valued activity under an HR, and examples would be things like doctors, university teachers, engineers, people involved in IT and communications, scientists, journalists and artists, then you'd qualify for a lower flat rate of 20%. That's the high valued activity rate. But it's also important to note that even if you don't fall under one of those occupation classifications, you can still benefit from the high valued activity rate if you're a director or senior manager of a company. Just also bear in mind the social security implications of earned income in Portugal, in that you'll have a social security liability as an employee, and also your employer will also have a liability to pay social security contributions in Portugal. However, there is an exemption, so you can continue to pay social security contributions in your home country for 2 years, assuming you're from a certain country that has the reciprocal agreement with Portugal. So the next question is how is investment income taxed in Portugal? And this is divided really into interest and dividends. And the general principle of non-habitual residence is that in order for it to be tax-free under non-habitual residence, it has to be taxed somewhere else. So interest and dividends are tax-free here, but they have to be taxed somewhere else, or taxable rather, and that's a key difference. Because the tax doesn't actually have to be applied in the country it's coming from. So let's take an example. If you have a UK limited company and you're receiving dividends from that company, the UK does have the ability to tax that dividend. So under the treaty, it has the ability to tax the dividend. However, it chooses not to. So it does satisfy the Portuguese NHR requirement that it is potentially taxable in the UK and therefore it's tax-free. It's just that the UK has chosen not to apply that tax. So you're getting it tax-free both from the UK end and the Portuguese side of things. The only caveat there is that you have to claim what's called disregarded income treatment in the UK to get the tax-free dividends and interest here. So how are capital gains taxed in Portugal? Well, this splits into two tracks. On one track we have the treatment of property sales, and on the other track we have share portfolios and investment sales. So if we consider property, for example, as a general rule, and this is certainly the case with the UK-Portugal Treaty, the treaty gives a taxing right on the sales of property to the state it's located. So if you've got a UK property, it will continue to be subject to UK capital gains tax. Now there is a pre-2015 rule, which I'll discuss in the description below, to mitigate any sales as a non-UK tax resident. But because it's taxable in the UK, Portugal will not tax any gains here whilst you're a non-habitual resident. If we consider the position though on share sales and investment portfolio sales, under the treaty the UK has no taxing right if it's a UK share portfolio. So because there's no tax there is tax here, and it will be subject to the 28% capital gains tax rate. And the final part of the NHR regime to think about that applies to a lot of people here at the moment is on pension income. Now, pension income is currently subject to a flat rate of 10% tax as a non-habitual resident, and that's for those that have got their NHR status after April 2020, because before that, if you got into the NHR scheme before then, you'd qualify for a 0% income rate. Now just be careful on this point, because from a Portuguese standpoint, a pension is seen as a regular series of income, so it's seen like an annuity. So if you take a large lump sum payment out of your pension, it could be actually classed as taxable income rather than a pension. So you just have to be careful about that point. That's not an issue for those applying for NHR after April 2020, but it's just something to keep in mind if you did get your NHR status before that point. What are some investment options that you can use as a Portuguese tax resident? Well, there's quite a few. You can have directly held collective portfolios or share portfolios. You can use trust structures, company held structures, pension schemes and bonds. There's quite a lot to choose from. However, one that's particularly common and I'm asked a lot of questions on these days is the Portuguese compliant bond. So I've done a separate video about that and I'll link to that in the description below. And the main aim of using these structures is really to mitigate tax and use them as a shell or wrapper to hold funds and securities within, so you don't have the ongoing tax on an arising basis and you can control the timing of the taxable events in your favour. The final question we come across a lot is, how do I avoid tax on the sale of my property? From a UK context, we know that the sale of our main residence is always free of tax. We're in a very fortunate position in that respect. In Portugal, it doesn't matter if you're selling your main residence or any other property, you're always going to pay capital gains tax on it. And there's two ways of avoiding that. The first way is to reinvest in another property within the EU. Now, some people don't want to do that, or they may want to downsize and they don't want to necessarily reinvest the full proceeds into another property, in which case there's another pension and investments option that we can use that does achieve the same capital gains tax avoidance, but there are restrictions on it. So if it is something that you want to consider and look at in a bit more detail, please let us know. We can look at your options and if it would be suitable for you and your situation. I hope you find those Q&As useful. If you have any other questions for me, please comment below or send me an email and I'll be happy to help. Thank you. Bye-bye.